Good day and welcome to this lecture presentation on standard costing and flexible budgeting. We are covering two topics and two chapters of your textbook, chapters 10 and 11. In the first part of this lecture, we will cover standard costing and direct cost analysis. And in chapter 11, the second part of the lecture, will cover flexible budgeting and overhead cost analysis. But before we go through the details of the coverage of this presentation, I'd like to share with you this quote from Benjamin Franklin. Benjamin Franklin is known as the founding father of the United States, and he said, "Beware of little expenses. A small leak will sink a great ship." In Proverbs chapter 27 verse 18, we are told, "Whoever tends a fig tree will eat its fruit, and he who guards his master will be honored." In this topic, we will learn how to compare actual versus standard costs. And you will find that sometimes the difference between standard and actual cost may be minute. It may be very small in dollar value, but in the grand scheme of things, it may actually be significant. And so this Bible verse and the quote admonish us to take care of the little things, because in due course we will reap the rewards. Let us pray. Our gracious Father in heaven, as we start this new topic, we would like to once again commit ourselves to you. Give us, Lord, the understanding, the discernment that we truly need. And we pray that you will guide us in our studies and also in our everyday life. We ask this in Jesus' name. Amen. All right. In this topic, we are covering 7 learning objectives. So in the first part of this presentation, we will cover learning objectives 1 to 4, and this should be covered in chapter 10 of your textbook. The rest of the learning objectives will be covered in the second part of this presentation. So let's get started with learning objective 1. Here, we will explain why standard costing systems are adopted and will describe how unit standards are set. So first up, why adopt standard cost systems? Well, there are 2 main reasons. First, standard costing systems enhance planning and control, and as a result, it improves performance measurement. Secondly, standard costing systems facilitate product costing. It is important to know how much should each product that we produce cost. Here is an example of a standard cost per unit. Let's say direct material cost is 2 kilograms and it's $5 per kilogram. So we are expecting to spend $10 per unit for direct materials. Direct labor, we are expecting to use 1/4 of an hour at an hourly rate of $20. So that will give us standard cost of $5. For variable overhead, we are basing it on direct labor hours, so it will also have 1/4 of an hour at $12 per hour rate. And so that would give us standard cost of $3. For fixed overhead, it is 1/4 of an hour at $8 per hour. So our standard cost is $2. So total standard cost per unit is $20. Now, imagine if we have spent $20.50 actual cost per unit. Now, you might say, oh, it's only 50 cents. But if we are producing, let's say, 100 10,000 units times 50 cents, that is still $50,000 worth of extra cost. And so you can see that cost control often means the difference between succeeding or failing. Now, how do we set those standards in the first place? Well, there are a variety of methods that could be used to set cost standards. One way is to look at historical data. So we will analyze how much did it cost in the past, and then from there we will set our current standard. Now, using historical data must be done with care because past historical data might include inefficiencies, and if the prices of materials and labor already increased, then that means past data may be irrelevant. All right. Another way of setting standards is using engineering methods. So here we'll need to determine how much material should be required and how much direct labor should be used in the production process. So for us to be able to say that we need a quarter of an hour of direct labor, we might have done some time and motion studies. For example, we might look at 10 people and ask them to do the same thing. And if some did it for half an hour, others did it for 1/10 of an hour, others did it for different length of time, we might average it up and we say, all right, a quarter of an hour is quite reasonable to expect for this particular product to be produced. All right. So in the real world, both historical cost analysis as well as engineering methods are used together. And there is also the use of benchmarking. So for example, the industry standards might be used as the benchmark for the company to set the standard cost for materials, the standard labor hours, standard labor rate, how much are we paying our workers might be based on, for example, minimum wage rate and the like. So there is some benchmark that will be used to determine the standard costs that will be set. All right. Now, let me talk about perfection versus practical standards and what do you think will be best used. So let us look at what are perfection standards. Perfection standards assumes peak efficiency that reflects minimum attainable costs under near perfect conditions. So if no one makes mistake, if the machine do not have any breakdown, if there's no power cut and all that every day, and let's say we can produce 10,000 units in an 8-hour working day. All right. So that is the perfection standards. Now, most of the time, there will be allowances for people to go on coffee break. There should be some allowance for in case you need to maintain the machinery or there is power shortage and the like. So, perfection standard will not allow for such things. Now, you might say, well, that might be so difficult to achieve. And you could be right. That's why one of the disadvantages of using perfection standard is that it may actually discourage employees from working hard because the standards are almost impossible to be achieved. But the upside to this is that it may motivate people to achieve the lowest cost possible. Another downside to using perfection standards is that it may encourage employees to sacrifice quality in order to achieve low costs. Now let's look at the practical standards. As the name suggests, practical standards are the minimum attainable costs under normal operating conditions. And this means there will be allowances for any downtime and wastage. So These practical standards may encourage more productive attitudes among employees. That's the upside to it. But the downside is that it may encourage inefficiency as well as wastage. Now, other companies may build continuous improvements into practical standards to make them more demanding. So, which do you think is preferable in practice? Well, practical standards, like I said, would be the one that is most likely to be used because perfection standard is more discouraging to employees rather than encouraging them to work harder. But it is always a good idea for practical standards to have some sort of the continuous improvement so that wastage and inefficiencies will be minimized. Let's now move on to learning objective 2. Here, we will outline the basic concepts underlying variance analysis and will explain when variances should be investigated. So, first up, how do we control costs under standard costing? Well, it's important to note that standard costing is indeed part of the budgetary control system. So how does it go? First, we will have the predetermined or the standard cost developed. A standard cost is simply a budgeted cost of one unit of product, just like what I've shown you in the previous slide. It will include the cost of the material, the labor, as well as the overhead, both variable and fixed overhead. Next, we will also calculate the actual cost incurred in the production process. So once we know the actual cost and the standard cost, then we can compare these two figures, and that would show us whether there is a difference between the actual versus the standard costs. The difference between these two costs is what we call the cost variance. Standard cost variances are used to evaluate actual performance and to control the costs. So when cost variances are significant, the cause of the variance must be investigated. So the question is, do we investigate every single cost variance? Well, most likely not. But we should investigate when, these are the guidelines, when the size of the variance is large or significant. Also, when these variances seems to be occurring often. Next, we will also have a look at the trends of the variance. Is it going up or is it going down? Either way, if we can see that the trend has been like that for quite some time, we should also investigate. For example, you might say, well, if the cost trend is going down, we should not bother checking it because it's good that the cost is going down, right? But it may actually mean that your standard is obsolete. Because if the costs keep on going down, what's the reason? If it's the labor rate costs that keep on going down, maybe the minimum wage has already gone down and you haven't adjusted your standard cost. We also look at the controllability of the cost item. If these costs are actually controllable and you can see a large size of the variance, then you should talk to the people concerned. The production manager perhaps need to be asked what is going on and asked to investigate further. We should also look at the nature of the variance. Is it favorable or is it unfavorable? If it is a large unfavorable variance, definitely you need to investigate it straight away. But if it is a large favorable variance, do you still have to investigate? Well, the answer is yes, you still need to. Because again, it may be that your standard costs may need to be adjusted. Or it may be that someone has been recording wrongly, all right? And therefore it needs further investigation. Also, a very good rule of thumb when you are deciding whether to investigate or not to investigate the variances is cost-benefit analysis. The cost-benefit approach is always good to consider, because if the benefit of investigating the variance outweighs the cost, then we should go ahead and investigate. But if the cost is higher than the benefit, then perhaps we should not go ahead and investigate further. All right, here is an example of a statistical control chart. You might have the favorable limit and the unfavorable limit as the bottom, and of course in the middle would be your desired value. Anything above the favorable limit and anything below the limit as shown in the red dots there will most likely have to be investigated. This is what we normally refer to as management by exception. Now, as a result of the investigation, this may give way to the operations being changed to bring the cost back in line with the standards, or management may reconsider whether the standard costs are appropriate benchmarks, or the standard costs may have to be updated to reflect current conditions and the current costs, whatever the case may be. All right, so now let's move on to learning objective 3. This is where we will learn how to calculate direct cost variances, direct material variances, and direct labor variances. We will use a corn chip manufacturer as our example for this. Here we are provided with the standard cost sheet for corn chips. It is common for many companies to have different materials for one product. So here, one bag of corn chips will use yellow corn, cooking oil, salt, lime, and of course the bags where they will pack the corn chips. It is also possible to have more than one type of direct labor. So they might have the inspectors who are only inspecting the corn chips, and the machine operators too. And of course, there will be overhead, variable as well as fixed. Let's focus first on direct materials and direct labor. Let's suppose that in the first week of March, 100,000 bags of corn chips are produced. Well, it says there that one bag of corn chips uses 18 grams of yellow corn. So the standard quantity of materials allowed for 100,000 bags of chips will be 18 grams times 100,000. So that is 1,800,000 grams. What about labor? Let's just focus on the machine operators. If we produce 100,000 bags and it uses 0.0008 of an hour to produce one bag, then that means the standard hours allowed for direct labor machine operators would be 80 direct labor hours. So that's 0.0008 times 100,000. You can see it's a very small figure, but when you multiply it by a big amount, it can be significant. Now let us have a look at the overall general description of variance analysis. In a columnar or tabular format, you will see something like this. You will compare the actual price at actual quantity with the standard price at actual quantity, and you will get the price variance. So when you compare the actual price and the standard price at actual quantity, you're deriving the formula here for the price variance. That means actual price minus standard price times the actual quantity equals your price variance. Now, when you move to the next part, you will now be comparing the middle section, standard price at actual quantity, with the standard price at standard quantity. And the difference here is what we refer to as the usage variance, also known as the quantity variance or efficiency variance. So again, you can derive the formula here. Actual quantity minus standard quantity times the standard price will give you the usage variance. Now, the total of the price variance and the usage variance is equal to what we refer to as the budget variance. All right, so how do we know when the variance is favorable or unfavorable? Well, unfavorable variances occur whenever the actual prices or the actual usage are greater than the standard price or standard usage. And of course, when it's the other way around, when it's the standard price and the standard usage that is greater than the actual price and the actual usage, then we have a favorable variance. So let us apply this in the corn chips manufacturer example. We will focus on the materials and the labor variances. Let's suppose this time that the actual production is 48,500 bags of corn chips. The actual cost of corn is 780,000 grams at 0.0069 per gram. So the actual cost is 5,382. And the actual cost of inspection labor, we are focusing on inspection labor this time, is 360 hours at $7.35, so 2,646. Now, we can tabulate here because what we want to do is to compare actual cost versus the budgeted costs in order for us to get the total variance, which is simply the difference between actual and budgeted cost. So the actual costs are given 5,382 for corn, $2,646 for inspection labor. What about budgeted cost? It says there that the standard price is 0.006 and the standard usage or the standard quantity is 18 grams. So we can calculate 48,500 bags times 18 grams times 0.006 will give us 5,238. So that is our budgeted cost. When you compare that with the actual cost incurred of 5,382, then we will have a difference of $144. Our actual cost is greater than the budgeted cost, so therefore it is unfavorable. Let's go to the inspection labor. The actual cost is given 2,646 and the budgeted cost can be calculated based on the standard cost sheet. We are supposed to have a standard price of $7 and the standard hours of 0.007. So we'll multiply the actual production 48,500 times 0.007, the standard hours allowed, times the standard price of $7, that would give us $2,376.50. So now we will get the difference between actual and budgeted cost, and we got $269.50. And again, this time actual cost is greater than the budgeted cost, so it is unfavorable. All right. Now, we know the total budget variances for corn, the direct material, and for inspection labor, the direct labor. But what we want to do now is to further analyze what happened to this direct material variance. So again, let's use the columnar approach. Let us compare actual quantity at actual actual price. So what is our actual quantity? It is given here, 780,000 grams at 0.0069. So that's 5,382, and that's the one that we have there. Now, the actual quantity at standard price can also be calculated easily. The actual quantity as given is 780,000. Multiply this by the standard price of the corn, which is 0.006, and that should give us $4,680. So when we get the difference between 4,680 and 5,382, we will get the price variance of $702. And because the actual quantity at actual price is greater than actual quantity at standard price, this is unfavorable. All right, let's now move on to the usage variance. We are comparing actual quantity at standard price with the standard quantity at standard price. So how do we calculate the standard quantity? Well, it is simply 48,500 units that we have produced, multiply it by the standard usage of 18 grams, and that would give us 873,000 grams. Then we'll multiply that standard quantity by the standard price of 0.006, and we will get 5,238. So when we get the difference between 5,238 and 4,680, that would give us $558, and that is favorable because we can see here that the standard quantity is greater than the actual quantity. So in this case, the total variance is simply 702 unfavorable and 558 favorable. Because one is favorable and the other one is unfavorable, we will actually get the difference. And that gives us $144. The unfavorable variance is greater, so this is unfavorable. So you can see that this total variance of 144 unfavorable, as we have seen earlier, is actually consisting of unfavorable price variance and a favorable usage variance. It's good to segregate this total variance into the different components of price and usage variance, because now we can see here whether we should investigate further this price variance. It may be that the price of corn has actually increased already, and therefore our standard price will need to be adjusted if this becomes a recurring thing. All right. In the usage variance, we would like to investigate this further because we'd like to know why is it that we are using a lot less quantity of yellow corn. Is it because we are reducing wastage? If that's the case, it's good. But if it is because we are using less corn and therefore the quantity of the corn per bag is a lot less, it is likely that our customers might complain because you are promising them this amount of corn chips and you are giving them a lot less. All right. So in this case, it might be worth further investigation if the usage variance, despite being favorable, becomes recurring. All right, so this is the columnar or the tabular method of calculating variances. Now, the formula method is another way of calculating the variances. So we have two material variances, the material price and the material usage variance. To calculate the material price variance, it's simply actual price per unit minus the standard price per unit multiplied by the actual quantity of material purchased. So that's why it's AQP, actual quantity purchased. So our actual price, you will recall, is 0.0069 per gram, and the standard price was 0.006. Our actual quantity purchased is 780,000 grams. So that would give us a price variance of $702, and that is unfavorable. Whenever you get positive figure using this formula, that means your actual price is greater than your standard price, and therefore this is unfavorable. Now, the material usage variance is simply given by the formula actual quantity of materials used minus the standard quantity multiplied by the standard price per unit. So here you would recall that the actual quantity was 780,000. Now, sometimes the company may purchase more but use less. But in this example, the actual quantity purchased is 780,000 and the actual quantity used is the same, 780,000. If the company purchased 800,000 grams but they only use 780,000 grams, then that means in the calculation of the material price variance, the actual quantity purchased, the 800,000 units, all right? It's the actual quantity purchased. But in the calculation of material usage variance, it is always the actual quantity used, all right? So here we have 780,000 minus the standard quantity of 873,000 grams. We've calculated that earlier, multiplied by the standard price of 0.006 will give us the material usage variance of $558. And remember, it is favorable because the standard quantity is greater than the actual quantity. All right. Now let's move on to the labor variances. We are starting again with the columnar or tabular approach. So here we are comparing the actual hours at actual rate by the actual hours at standard rate to calculate for the rate variance, which is also the same as the price variance. So our actual hours is 360 as given here. And the actual rate is $7.35. Therefore, that gives us 2,646. Then we'll compare that with the actual hours of 360 at the standard rate of $7 as shown in the standard cost sheet. So 360 times $7 is 2,520. So the difference between 2,646 and 2,520 is your rate variance of $126, and it is unfavorable because your actual hours at actual rate is greater than actual hours at standard rate. Next, we'll move on to the usage or the efficiency variance. So we will now compare this middle figure, 2,520, with the standard hours at standard rate. The standard hours of 339.5 is calculated by multiplying the actual number of output produced, 48,500 bags, with the standard usage or the standard hours for inspectors, 0.007. So that would give us 339.5. Then we'll multiply that by the standard rate, which is given here at $7. So that gives us $2,376.50. So the difference between this figure and the middle figure, 2,520, is $143.50. And that is the efficiency variance. This is again unfavorable because the actual hours is greater than the standard hours. All right. Now, the total of the rate and efficiency variance is $269.50. They are both unfavorable, so we'll add, and that gives us $269.50 unfavorable, and that's the total variance that we have shown earlier. All right, so that is the columnar or tabular approach to calculating direct labor variances. Let's now move to the formula method. So we will calculate the labor rate variance using the formula actual hourly rate minus the standard hourly rate multiplied by the actual hours of direct labor. So in our illustrative example, the actual rate for labor was $7.35. The standard rate is $7, and the actual hours was 360 hours. So that would give us a labor rate variance of $126, and it is unfavorable because the actual rate is greater than the standard rate. To calculate the labor efficiency variance using the formula method, we will use the formula actual hours minus standard hours multiplied by standard hourly wage rate. So you would recall that the actual hours was 360 and the standard hours was 339.5 hours. We'll multiply that by the standard rate of $7, and we will get $143.50 labor efficiency variance. And again, this is unfavorable because, as you can see, the actual hours exceeded the standard hours allowed. Now, let us move on to Learning Objective 4. This is where we will prepare the relevant journal entries to record and close direct cost variances. So, how do we record the purchase of raw materials when we are using standard costing? Well, we will be debiting the raw materials inventory, and we will credit the accounts payable normally or cash when we are using the normal costing. But if we are using standard costing, we will be debiting raw materials inventory for the standard price, $4,680 as shown earlier. Now, remember that we have an unfavorable material price variance. So whenever there is unfavorable material variance, we will debit that. So we'll debit material price variance for $702, and our credit would be to accounts payable at $5,382. So accounts payable will be credited for the actual quantity at the actual price. Now, to record the use of raw materials in production, we will be debiting work in process as usual, and will credit raw materials inventory. However, if we are using standard costing, we will be debiting work in process inventory for the standard quantity at standard price. So that was $5,238. Then we will credit material usage variance, because you would recall that our usage variance for materials was favorable. So whenever we have a favorable variance, we will credit it. And that was for the amount of $558. We will also credit raw materials inventory for $4,680. Remember that that was the actual quantity at standard price. Now, how do we record the use of direct labor in production? When we're using standard costing, we will still be debiting work in process inventory for the standard hours at standard rate. So remember, that was $2,376.50. Then you would recall that we have unfavorable variances for both the labor rate and the labor efficiency variance. So we'll have to debit this. We'll debit labor rate variance for $126 and also debit labor efficiency variance for $143.50. And we'll credit the wages payable for $2,646. This is the actual hours at the actual rate. Once we are done with the accounting period, we will be closing the material and labor variances to the cost of goods sold. So we'll debit the cost of goods sold and either debit or credit the variances depending on whether we have debited or credited them originally. So our entry would be to debit the cost of goods sold for the total direct material and direct labor variance, and that gives us $413.50. So what else do we debit and credit? Well, you would recall that we have debited material price variance for $702, so we'll need to credit that to close it. So we'll credit direct material price variance $702. You would also remember that material usage variance being favorable was credited. So to close that, we'll need to debit material usage variance for $558. For the labor rate and labor efficiency variances, we have debited this because these are unfavorable. We've debited these for $126 and $143.50, and so now we'll need to credit labor rate variance for $126 and labor efficiency variance for $143.50. All right, well, this is it for the first part of this lecture. We have covered Chapter 10 of your textbook. So we will pause here for a while and we will continue with Chapter 11 in the next part of this lecture. Bye-bye for now.